Hello, welcome to the first of a series of webinars which we at HANetf and our partner Harbour Capital will be hosting together to delve into the world of active ETFs. My name is Manoj Mistry and I am Chief Operating Officer at HANetf. HANetf is Europe's first and leading provider of white label investment solutions through exchange-traded products. As a white label platform, we offer our partners such as Harbour Capital, who are with us today, the opportunity to offer their investment strategies to investors in Europe and further afield in markets such as Asia and Latin America through the exchange-traded product wrapper. At HANetf, we recently passed the 8th anniversary of the launch of our first ETF for a partner. We now have over 30 partners with over 50 products and almost $10 billion of assets on our platform. Our white label platform offers a broad range of exposures, including both actively managed and index strategies across all different types of asset classes. We have thematic equity, where we offer products on the digital economy, healthcare, defense, mining, and energy. We have fixed income ETFs covering sovereign debt, credit, and emerging markets. We also offer income strategies, which are option-based or investing directly in high-yielding assets, such as preference shares. We also offer physical commodities, such as sustainable gold and uranium. And we also offer a range of crypto and digital asset ETPs, all on our platform. All of these products offer the convenience of trading through the ETF wrapper, which allows investors to trade throughout the normal trading day. I'd also like to introduce you to my co-host today, Bryan Moore from Harbour Capital. I'm going to ask him to introduce himself and also tell us about Harbour Capital.
Thank you, Manoj, and everybody here today. Bryan Moore, I have started out my career, been in the business almost as long as Manoj has. I'm very close, we were talking about earlier. Started on the trading side, so I've been trading ETFs really since shortly after the first one was launched here in the United States. So I've seen the business grow from just a handful to as big as it is today. And one of the things that's most exciting that I'm glad we're here to talk about today is that transition over the past 5 years, where we've seen active ETFs kind of really take hold in the marketplace. Here at Harbour, what we do is find boutique managers or kind of hidden managers that have offer idiosyncratic alpha for specifically designed areas that they focus on, whether it be small caps, whether it be healthcare, or anything else, and we bring them to the marketplace. So very excited to talk about ETFs today, and here at Harbour, as Manoj pointed out, we've partnered with them to launch one of our ETFs in the European market as well. Excellent, thank you very much.
Bryan. Yeah, thank you. So the format of the webinar today is that there'll be a 30-minute Q&A between Bryan and myself, where I will ask him a series of questions about active ETFs, and then we'll also moving on to a Q&A. And what we can do, or what you can do, is that if you have any questions, you can ask questions throughout this webinar. So if you look at the bottom of your screen, there should be a Q&A icon, which you can click on, and then basically you can input your questions, and then we will endeavor to answer them as we go along or towards the end of the webinar. As I mentioned, this is the first of a series of discussions, and today very much we'd like to introduce the topic of active ETFs, what they are, how they are set up, and also talk about how the market is evolving. And we may not get a chance to answer every question today, but I think that's a good excuse for you to come and listen to the next webinar, where we'll be storing up any questions which we don't answer today. So with that, I'm going to launch into the first question I have for Bryan today. And I'm going to ask a very straightforward question. Can you explain, Bryan, what is meant by an active ETF?
Sure, definitely. I think what we've seen kind of over the progression, everybody started with passive ETFs, which are typically index-based. So they're following an index and they rebalance when the index rebalances. Then we kind of moved into this area of smart beta, it's called the past couple of years, which is rules-based, passive indexing to a certain extent, but a little bit more active and factor-based. And now I think what we've done is we've come full circle to active ETFs. And so the difference between an active ETF and say a passive ETF or even a smart beta ETF is there's a portfolio management team behind that active ETF who's making decisions on whether to add stocks, increase weighting or decrease weighting to those stocks. So what you're really getting is something that's not rules based. You're not getting something that's following a market cap weighted indice or an equal weighted indice. You're getting something that really expresses the portfolio manager's team of what are the best investable options that they would like to have in their ETF.
Thank you, Bryan. And yeah, no, I agree. Even here in Europe, I think obviously the first ETFs were launched 25 years ago, and yeah, they were all originally index products, but we've seen active ETFs emerging in the last few years as well. And why do you think that is? What's driving the active interest in active ETFs over the last couple of years?
I think it's really one. I think at least in the U.S., I think the SEC rulings, the 2019 ETF rule 6C11 here, kind of opened the launch pad for a lot of managers to start expressing their opinions, investable opinions in the ETF wrapper. But I also think it kind of is coming from we've seen such a low interest rate environment here in the U.S. and across several geographies. And now when rates have started to pick up, obviously we're cutting them here now as you guys are, but you're still higher than you were, say, 5 to 10 years ago. And so I think what that does is that, and combined with the central banks no longer feeling like they have the markets back as they have to battle inflation and kind of take other factors into consideration, really, it's kind of moved people away from just saying, oh, I'll just buy the indices and just let it go, because the central banks are always going to be there to cut rates, and they're always going to be there to say something positive to support the market. And it's just, everything's going to kind of go up as one. And we're not seeing that happen anymore. Now you're actually starting to see, with higher rates globally, certain themes and certain stocks are taking advantage of that better than others. And so I think you're starting to see, at least here in the States, we're much more correlated to a defined set of names called the Mag 7. I know Europe has their own, but it's people need investment ideas outside of that. And so I think that's really it's multiple factors coming together to really highlight the need for diversified investments.
Thank you, Bryan. I know you have a selection of interesting facts about the active ETF market in the US. Would you like to share some for the benefit of our audience?
Sure. I think it's funny on the prep call on this, and one of the things I like to tell people is, and this is what really nobody in the States knows, is that there's almost as many active ETFs as there are passive. And you can say that to professional portfolio managers and money managers, and they'll kind of look at you like, what? And you're like, yeah, it's the numbers very close. And I think that really kind of speaks to the adoption, at least on the issuing side, as to how we think, and what we do on the issuing side, as Han does, you're responding to client demand, right? So that's what investors really want. And I think one of the things that I also like to hear is we've really moved on. The first slew of active ETFs started in the fixed income arena, but you're really starting to see that migrate over into the equity space, and that's where even in the commodity space. And so you're starting to see a lot of assets gain over there as well.
Thank you. Yeah, no, here in Europe as well is a similar kind of story where the active ETFs have existed, I guess, for about 7-8 years in Europe now as well. But we've seen over the last couple of years, especially, a lot of traditional active asset managers entering the space. And I think in Europe, obviously, it's still way behind the US market, and there are different drivers of the growth. But we, as a white label platform, have been, to a certain extent, surprised by the level of activity and the number of new entrants coming into the active ETF space. And from that, like, in terms of, say, managing an active ETF, how different is it to running an active mutual fund from the portfolio management perspective?
Yeah, I think there is. So one of the things when we bring on a supervisor or whenever we're talking to our portfolio managers internally, one of the things we like to do is, because obviously this has to be priced and traded by the market making community or by trading desks. So you try to say, if you're going to do any trading, try to do it around the close on the rebalancing side. That way, let's keep kind of any major portfolio shifts to kind of more defined times and not just at random 9:30 on a random Wednesday. But I think to look at that on the other side, I think the trading community has also become very good at kind of looking at what the portfolio managers are doing and how they're making portfolio adjustments, and be much more kind of attuned to that risk and being able to price that into their models. So I think it's been something where both sides have kind of given a little, but you're starting to see as you go on, the market makers are getting more comfortable with what the portfolio managers are doing. And the portfolio managers on the flip side are getting more comfortable in how the market making and basically the market is pricing their products. And so I think one of the things that leads into this is you obviously have all of these semi-transparent, transparent wrappers and everything else. But I think one of the key things is, it's become the transparency that exists in active as there is in passive is really, I think, helped kind of make a lot of the fears and kind of concerns go away.
Yeah, no, in Europe so far, most of the active ETFs have been fully transparent, and it's only recently that the regulators have allowed for semi-transparent products. How is it in the US? What's the mix between transparent, semi-transparent, non-transparent? How are the assets split, sort of?
Yeah, there's one big firm here that has a semi-transparent model. There's a couple of other smaller ones. Me personally, I think one of the things that ETFs and that really investors like is being able to just see what's in the portfolio on a daily basis. That's something that I think when you're talking about ETFs, one of the words that obviously comes to mind, at least to me, is transparency, right? I can see it on a screen. I can see the pricing. I can see a bid and an ask. And so to obfuscate that kind of feels un-ETF-ish. And I don't want to, I'm not criticizing anybody because obviously there are certain PMs who may do things in their baskets that others don't. But, predominantly here in the States, the fully transparent ones have grown at a much faster rate than the semi-transparent ones. And I see that trend probably continuing because the mutual funds that I'm talking to now that are looking to kind of make that jump over to the ETF wrapper are, you talk to them, they go, "Are you going to go semi-transparent?" And they kind of look at me like, "What?" And you're like, "I guess not." So we're going on this transparent model. And I think that kind of really speaks to a lot of portfolio managers becoming more comfortable. Just, it's like, yes, we can have our investment ideas and philosophy, but we feel confident that, what we're bringing to the table matters. And if somebody chooses to try to buy the stocks 2 to 3 days later, then so be it. We feel we're doing it in a much more efficient manner.
Yeah. And I was going to ask you, what are the kind of advantages of say an active ETF versus an active mutual fund, sort of from an investor, but also from a portfolio manager perspective?
Well, I think for an investor, one of the biggest ones is they can trade it intraday. If they do wake up at whenever they want to, and they want to sell out of it on because they saw some news and they think there's a thematic change that they need to express, they can do that. I think that's a huge thing. Also, I think one of the advantages, it is a little bit more tax efficient and less costly to run an ETF here in the States than it is a mutual fund. So that's typically one of the reasons why you do see the fees a little bit lower on the ETF side. But I think there's also a couple other reasons. I think because of the creation redemption process when shares are created and redeemed, it can afford the portfolio management team an ability to kind of be a little more tax conscious when it comes to creating that.
Yeah, and in terms of, are there any disadvantages to balance out the questions?
It's funny, and I'm sure you would agree with me. There's certain products that I feel, I'm not going to go into details, but there's certain products that I don't feel should be in an ETF, right? I mean, I think there's certain ones that you do need that transparency, and you do need that semi-consistent, or consistent pricing. So, there's definitely certain products out there that you kind of look at and you're going, "Ooh, okay, you did that, you jumped that chasm. Okay, great." But yeah, I think we're both talking about it really comes back to transparency and really giving clients kind of what they know. And one of the recent things we've seen here is a lot of these callable options ETFs, being launched and kind of people in the search for yield. So I think it's interesting. It's going to be, people are looking at different ways now, and it's going to be interesting to me to see how active issuers adopt to that.
Yeah, I agree completely. I think whenever you speak to sort of people from the ETF industry, I think one of the reasons they like working in the ETF industry is because of the fact that the products are transparent and accessible by investors. And I think that's always been a cornerstone. And I would also concur with you that at the end of the day, not everything is suitable for the ETF wrapper. There, I think it works very well if the underlying is liquid, is easily traded. So that lends itself to being an exchange traded product. Whereas I think we all see that maybe there's a certain asset classes, certain types of markets which may not lend themselves, and for that the mutual fund is a perfectly good alternative, good wrapper to use. Whereas ETFs, I think, definitely should or are becoming very much the wrapper of choice for liquid investment strategies. In terms of, you hit upon it earlier, in terms of certain segments of the sectors of the active ETF market are gathering traction and interest from investors. Which areas are you seeing these in the US market at the moment? So.
Yeah, I think what's interesting here in the States, you're talking to people, I think, if we went back even 5 years ago, they would say, well, I use ETFs for kind of just core allocations. If I want the large cap, fine, I'll buy, a passive ETF. When it comes to international or emerging markets, those are areas where I feel that a portfolio management team can actually add some value. And so I think, the investors and REAs would say the same thing about, fixed income. So I think, those are the areas where you're seeing really a lot of growth on the active management side. I would say, the commodity space, I would say fixed income has always been there, but I would say international exposure, I would say definitely emerging market exposure. Those are, I wouldn't say it's more friction, but I would say you kind of, there was an old joke here, you just don't want to own the European banks. You want to own something else besides that, even though European banks have been doing much better than they were previously over the first decade. But anywhere, and I think that even if I'm sitting in Europe and I'm looking at the US, I probably want to own, there's definitely certain segments that I would want to own rather than just owning, 40%, of the Mag 7, of my index having the Mag 7. So I think it's really, having kind of concentrated pockets and being able to diversify and find hidden gems within that really translates itself to everywhere. But here domestically, I think we're seeing kind of more international EM.
Good. Just a reminder for the audience that if you do have any questions, please use the icon at the bottom of the screen, the Q&A icon, and you can just click on there, submit your questions, and we'll have them answered during this session. In terms of where you see growth areas or potential areas where active ETFs could evolve into, do you have any thoughts, or using your crystal ball in terms of how you see the market evolving?
Yes. Well, I do think, obviously there's one similar theme that we share, I think globally, is AI. And I think everybody's trying to rush and create these first gen AI products, which is great, but we're getting to a point where it's going to be interesting to see if there's a second generation of companies and globally that benefit from this. Because I think we can all look at the surface and go, we're seeing these hyperscalers or whatever benefit, day one, but obviously that money has to flow down to somebody else as well. So I think that's a good one. So energy transition is another area. I think there's even in like small cap, I think when we are in a cutting rate environment, some of the, you go down the cap structure, and I think that actually lends itself to really owning some interesting names rather than broad-based indices.
Okay. I actually have the first question come through, so I'm going to ask that. So it's from Paloma, and the question is, where do you buy active ETFs, and who is the biggest provider? Maybe I can answer it for the Europe, and you can answer it for the US market. So,
perfect.
Yeah. So I let you go first if you're happy.
Okay.
Yeah.
I think, pretty much here in the States, you can buy them on any of the major platforms. There's obviously, you've heard of kind of online platforms like Robinhood. I think, can provide you access to the US markets where everything's going to be traded on exchange. You're going to be able to see, the pricing. It's going to be transparent. I think, what are the active ones? Well, you still see a lot of the bigger managers have a larger percentage of kind of weightings, and when it comes to when you're looking at kind of managers who had an active ETF exposure assets under management. What I will say is it's less concentrated on the active side than it is on the passive side. The passive side, the handfuls, the Vanguards, the BlackRocks, the State Streets of the world have more than the lion's share of assets. On the active side, you're seeing kind of more boutique offerings. People like Harbor, we're creating something that the active, the big boys don't have. And I think that's part of that idiosyncratic alpha, and finding boutique managers who have been kind of doing things differently for quite some time really adds value. And I would think you guys share a lot of that, finding, looking outside of kind of some of the major cities and kind of some of the, the more known issuers and managers to find those people who are kind of looking at the world through a different, prism or a slightly different angle.
Yeah, I agree. And it's a similar, as you say, similar picture here in Europe that, active ETFs can be purchased in the same way as you would buy a regular index ETF. You buy it through your platform or broker. And I think one of the trends we've seen is that there's a lot of these platforms emerging, and we see a lot of retail investors accessing ETFs in general, including active ETFs. And I think that's one of the reasons why we also see a lot of active managers now entering the ETF space. We've seen just in Europe over the last few months some traditional active managers, people like Jupiter, who've entered the ETF market via the Han platform. But we've also seen others coming, such as Schroders, Robeco, who've launched active ETFs in the market. I think one of the there's obviously, I think, the other part of the question, who are the biggest providers? And it's a similar story here in Europe, where on the index and passive side, there's a high concentration with the big names, and they dominate that market. But the active space is much more diversified. I think in Europe, the biggest provider is JP Morgan, but they entered the space 7-8 years ago, so they've had a head start. And what we now see is a number of active managers trying to follow the JP Morgan model to enter into the European market as well.
To follow up on this, and I would love to hear your thoughts. I think one of the things, retail at this point in time seems to be much more relevant to what we issue and who's actually doing a lot of the buying and trading of names like this. I think it used to be, as a trader, nothing against retail traders, used to be when retail's in, okay, that's it, we're getting near the end, but it's not that way anymore. What we've seen, and definitely probably since COVID, is retail's at the forefront. They're actually the ones who are really, I would say that the institutional money managers obviously still carry a big, cricket stick, but retail's getting up there, right there with them. And they're really, I think, what's driving a lot of what the industry is issuing these days, which is, definitely something different for us. But I'd love to hear, we think it's probably similar in the European markets.
Yeah, historically, like Europe is very much a sort of what I call an institutional market. And there, basically, what I mean by institutions is both large institutions like, say, pension funds, insurance companies, but also institutions that face retail investors, so private banks, wealth managers. And those sort of segments have typically probably dominated 70-80% of ETF assets in Europe. But what we are now seeing, and Europe hasn't always had an equity buying culture like you have in the US. A lot of investment products in Europe are purchased through your bank or IFA, your financial advisor, or through your insurance company. But I think what we're now seeing is, with the emergence of the neo brokers and platforms, is that retail investors are now buying investment products directly, typically on their phone, but in a very easy way. And ETFs lend themselves very much to that, for people to buy products instantly, effectively. And what we also are seeing is that I think investors are becoming more savvy, more aware, and I think more information is available. You can get it online. You can, although I'm not on social media, there's a lot of learning and information exchange happening on social media. So investors are much more better informed, and they're able to make investment decisions. Whereas, and I always say, like, ETFs from the very beginning were very much a democratic investment product, in that retail investors could invest on the same terms as institutional investors. And that part of that was information and transparency. And we're seeing that now with the active strategies coming in, people have much more information available, the transparency to be able to access these products. I have a few more questions which have come in, so I'm going to launch into those. This one is a good one from Eugene. Does this mean the end for equity mutual funds? Maybe you can comment on the flows you are seeing in the US market, and also, here in Europe, I can comment as well. So,
You never want to say it's the end of anything, because there's certain investment, wrappers here in the US that where having capital gains doesn't hurt them as bad as it does kind of others, and say our 401k. So I don't think it's necessarily the end. But we are seeing, I think you can't deny that there is a continuing migration away from mutual funds on the equity side. And I think you're seeing that kind of go into collective investment trusts. You're seeing it go into separately managed accounts for some of the bigger institutions and pensions. But I do see, I would say the train's left the station, and you do kind of see this just kind of continual kind of march lower on that side. But you never want to say it's the end. I don't think they go away, because as we were talking about earlier, there's just certain asset classes and certain exposures that I think are better than mutual fund space. But for equities, I can continue the downhill slide would be my bet if I had a crystal ball.
Thank you. Yeah, no, I agree. I think over time, I think and my background is very much on the indexing side, but we've seen obviously index strategies taking market share from equity mutual funds for many years now, and I think it's forced a change in terms of how a lot of actively managed funds, especially on the equity side, have been managed as well. I think when I first started out, there was always a term in the UK called closet index tracking funds, where you'd basically be an active manager, and you would sort of maybe if you're tracking the FTSE 100, you may buy 80 stocks and still try and beat the benchmark. But I think one thing it has forced is a change in terms of how actively managed funds on the equity side, especially. And I think there's been a push where funds have a much higher active share and maybe more high conviction type strategies, which I think are the type of strategies which have survived in the mutual fund wrapper so far in when it comes to equities. And we do see also those type of strategies coming over into the ETF wrapper as well, which kind of also lend themselves because they are concentrated portfolios, and the underlying is typically quite liquid. I also have another question from Abinit, and his question is, do you think that wealth managers could become issuers of their own ETFs, in effect manage a diversified portfolio through customized ETFs of their own? I think this is a trend in the US, and maybe you can give some more detail.
It is. You're definitely seeing, I think, Morgan Stanley, to name a few names, JP Morgan, obviously, just like they do over in Europe, have a huge offering here in the States. But I think one of the things that these firms, they have core competencies that they feel they can do very well, and obviously they can. But I do think, when you start to get to some of these more satellite areas or kind of smaller niche plays is probably not the right word, but I'm going to go with it. Then you really kind of want to go down and find those boutique active managers who kind of look at the world a little bit different. I think if you're talking about going down the cap structure like small caps, I think that's where an active manager is going to be able to look at the world and devote more time and research to maybe that segment than probably some of the big banks would want to even do. I think they're going to look at it and go, it's not worth our time. So we'll create models for our advisors, but we are still going to go look outside, obviously their four walls and look for those managers who are doing things. I think one of the things which feeds back into the retail we were talking about earlier is, you can get on podcasts. Retail investors are looking at areas. And so I think you do see, here in the US, if I'm an investor and I go to my, bulge bracket or big bank advisor and they try to give me 100% of the portfolio as their products, I'm going to go, really? There's nobody else out there does anything good. And so I think, that may happen, but I think it's happening to a much less extent than people initially feared.
Yeah, no, and We're seeing similar, and as a white label platform, we've had interest from sort of wealth managers, family offices, who wanting to basically, if they're managing a load of segregated accounts or managed accounts, and then consolidating them into an ETF wrapper and then being able to sell that. So yeah, no, we're seeing that trend emerging here in Europe, and I think the benefit is that, especially in Europe, is that where, unlike the US, we have multiple exchanges where products are offered. We have multiple languages. We have multiple tax regimes. But we know that with, say, UCITS ETFs, they can be passported across Europe, and there's no easier way in terms of expanding your footprint via the ETF wrapper. And that's why I think a lot of managers are looking at ETFs now very much as a growth engine and for their businesses. I have another question, and this is in relation to liquidity, which you sort of touched upon, but it's from Bryan, and the question is: do you see enough liquidity, enough publicly traded small cap companies to have a competitive amount of small cap ETFs in the US and Europe?
So, okay, I didn't put this question in myself, so it's a different Bryan, but
Yeah.
I do. I think, you know, you've got kind of your stock pickers who have their own fundamental analysis and how they're looking at stocks. Then you've got people who are dissecting the universe via factors, and so they have much more different slices in the way they're looking at stocks. And so I think that the opportunity has never been greater to express and gain an exposure in small caps than ever before. And so I think that's really going to lend itself to investors being able to kind of, you know, build up that asset base.
Thank you, Bryan. We have around 10 minutes left, so please, feel free to continue asking questions. I have another one, which is kind of both of them on a similar vein. One is from Helen, and she's asking, is there an asset size below which an ETF is not viable? And then there's a similar question from an anonymous who's typically asking, so what's a typically economically viable amount based on the sort of the usual fee structure? What's your experience of sort of, like, obviously, I think same as mutual funds, the ETF market is obviously dominated by lots of big funds, lots of small, medium-sized funds, and then lots of small funds. And obviously, a lot of people will ask, how do the small funds survive? When do the issuers decide when to close them down? I don't know what your experience and views are of this. So.
Well, I think if we went back 15 years ago, a lot of people would issue 20 funds at a clip sometimes. And yeah. I think you're really trying to see, okay, what's going to stick to the wall? You know, what's going to take off? And then that kind of migrated over into let's create a fund and list it that we think is going to be well in a couple of years, given the current market environment. I think since 2019 and since we've lowered the barriers to creating and issuing ETFs here in the States, what we're seeing is people, obviously issuance is up. I think that is giving people more choices and more opportunities to express their investable opinions in different ways. So we haven't really seen, you know, you are seeing ETFs be kind of closed, and that's just part of the cycle of life, for lack of kind of a better analogy. I think it's one of those things that sometimes, you know, things take off, but what we're seeing that makes things a little bit different here, I believe, and one of the attributions that could kind of add to success to an ETF and make them linger or kind of exist even longer is really kind of working with established issuers and kind of white labels such as, you know, Han. I think, you know, what a lot of people don't realize and appreciate is that it takes a team to kind of have a mutual fund or an ETF. And I think around that, you need, you know, some distribution to help that out. You know, I think you need kind of support, you know, operations. And so these are all things that, you know, you do have some kind of go on their own without kind of a designated market maker here in the States. And those can, you know, stay around for a couple of years, maybe before they close. But you're starting to see people understand there's an ecosystem behind the ETF wrapper itself. And I think that lends itself to the universe continuing to grow at a pretty big rate. Asset wise, typically $50 million USD is kind of an area where things start to break even and become a little bit slightly profitable for an issuer. I think, you know, you're seeing a lot of that. But what as somebody who kind of, looks at the world from a trading lens, the majority of ETFs trade under, I'd say 500,000 shares a day. And the bulk of them trade kind of in that 0 to 25,000 shares a day. And so I think that's one of the things that, will a lot of those go away? Some, but it's still, they're still out there. And as long as they can kind of express the opinions that, the people who are managing them want, then, they can stay around. So I think, there's where we've moved away from, we're going to launch a bunch of stuff and then we'll pull back what we can. But what's not doesn't resonate. To now, I think people are being much more strategic about what they're launching initially. And so I think that's going to extend that timeline. Love to hear your thoughts on that.
Yeah, no, similar. In Europe, there is a big tail of small funds, but from experience, what you see is obviously if you're a small issuer or a small provider, then maybe you're more under pressure to review those, especially if the products haven't had much traction at the launch. But then I know, having worked at large issuers, is that your lead time for keeping the products running could be quite long, because you think, okay, maybe you've got the timing wrong. You could have launched a product too late in the cycle. So you may wait for the cycle and the markets to recover before that product has traction. And I have seen many examples where a fund which may have been sub profitable size for many years, but then all of a sudden it's the right product at the right time and basically has traction and it's there and investors are doing. And obviously that provider has taken the risk and they basically put the product on the shelf. But yeah, you can't get everything right. But I do, yeah. And I think it's also from the ETF market perspective, quite healthy that products do close down as well, because at the end of the day, investors are voting with their wallet and deciding which of the products they want. I think one of the things I've learned in my career is develop products which the market wants, rather than developing products which you think the market wants. And I think it's very much true within the ETF space, where you see a lot of innovation, you see a lot of new ideas and strategies coming to market, but not all of them are going to work. But I think that's also healthy for the market, because there are issuers out there who want to try these new things and bring ideas to the market. I think you touched upon it earlier. Like there are various types of, say, covered call strategies, which if no one had tried to bring them to market, then we wouldn't be in a situation where that's one of the fastest growing segments, both in the US, but also in Europe. So I think it's very healthy that the market can allow for innovation, and then products close or drop by the wayside if they are suboptimal as well. I think.
Go ahead. Sorry.
No, carry on, bro.
I think just representing, to tie what we were both saying, I think the industry is much more reactive to investors' demands these days. And I think that's instead of actually, and so I think when we do launch stuff, I think we have a higher conviction a lot of time, which feeds into those can kind of hang around, because we're just like, you know what, we launched this, we know it generates alpha, we know it's a good investment philosophy. I mean, do you guys feel that way? I think, here, that's why you do see, like you just mentioned, that kind of extra maybe year or two lingering around, and then you do see it take off.
Yeah, no, I think that's definitely the case. And obviously, some we've seen, like some themes are very short term, but generally I think most of the products coming to market are long term. And as I was saying, you maybe need to ride out the market cycle to sort of see it through and keep the product valid. Bryan, I was going to ask, like, did you have any questions for me from a European angle? Was there anything you wanted me to answer on your if there's any questions you think could be interesting? We've got 5 minutes left. So, yeah.
I do think when it's, and this is one of the things, obviously everybody has their own geographic bias to a certain point. It'd be interesting when the European community looks at the States, what do they see as the opportunity for active ETFs? I mean, I think if you look at us, we are typically talking to the US driven retail community, and pensions investors. But I think, just like when you go find that boutique manager who looks at things maybe 1 degree off, what does the European investment space look at us and say, there's a better way to do that?
Yeah, no, I think in Europe, the drivers, I think, of the active ETFs are very different to the US, and part of that is the tax reasons. We don't have
Yes.
the same benefits of the tax benefits of the ETF wrapper, but there are certain benefits based on where you domicile in ETF and the treatment you get on things like withholding tax. For example, Ireland is more efficient than, say, other jurisdictions in Europe for US equities or withholding tax on US equities. But I think ultimately what we see is that with the kind of evolving strategies in the market, is that at the end of the day, sort of a lot of providers are sort of, as you say, responding to what investors are looking for. And I think passive and indexing is a much larger proportion of assets than it was 10 years ago. I think that proportion will still grow. So in order for active management to kind of sort of almost justify its existence, is that they have to evolve with the market. And then part of that is how can you generate better returns for investors? And I think that's very important. And doing that within the ETF wrapper, I think is a great way for active ETFs to have or for the active industry in general to have a sort of a continue its existence. And although as I mentioned earlier, I'm from an index background, I think it's very healthy to have both active managers and passive managers as well. I think they can equally coexist and give investors a range of opportunities and investment choice. So
yeah, I think agree with you 110%. I think I was talking to somebody just yesterday, and I said, as a trader, I look at it as there's trading vehicles and there's investment vehicles. And I think having those big bulk strategies, the index wrapper on the passive side, if somebody came to you and said you need to invest, 100 million today, fine, boom, you can do that with minimal impact, because a lot of those names and tickers have a whole ecosystem of options based and kind of futures based around them, so they do provide enhanced liquidity. But over time, when you then now have that kind of, you've covered that broad-based exposure, you now have time to rotate that into something a little bit more active and kind of precise. So I agree completely. I think there's a space for both. But I do think kind of active's on the upswing, whereas passive, I don't see it going away, but moderating.
Okay, thank you. I just noticed we're at the end of our 45 minutes. I don't know if you have any closing remarks, Bryan, but no, thank you. Thank you very much.
No, thank you. And thank you, HANetf, for having me here today. And I think this is a space we were talking earlier. It's constantly changing. So look forward to continuing to, to do these as more questions arise.
Yeah, thank you very much, Bryan, and thank you to Harbour Capital for helping us host this. For those of you who registered for the event, we will be sending a replay of this webinar by email, and we'll also be sending contact details. So if you have any questions, please respond to that email, and we'll endeavour to get back to you as soon as we can. And yeah, thank you very much for listening. And yeah, we hope to welcome you to the next one of these. We'll, as I said at the beginning, we'll be diving deeper into the details of the products. This was very much an introduction, but we look forward to seeing you at the next webinar. Thank you very much.